Welcome back to our channel. Today we are going to talk about short selling for beginners. Short selling is an advanced trading strategy that can be used to profit from falling stock prices. It is a powerful tool that allows investors to make money when the stock market is in a downturn. In this video, we'll explain everything you need to know about short selling and how to get started. Let's dive in. What is short selling? Short selling is the act of selling a stock that you don't own, hoping that the price of that stock will fall. You borrow the stock from your broker, sell it on the open market, and then buy it back later at a lower price. The difference between the selling price and the buying price is your profit. It's helpful to contrast this with a normal trading or investment strategy. Most traders and investors buy stocks with the hope that their value will increase over time. Longer-term investors also bank on receiving dividend income. But what happens if you think a company is mismanaged and the price of a stock is likely to fall rather than rise? With a traditional trading strategy, you can avoid owning the stock, but you can't really make money from it. With short selling, traders can attempt to profit from a fall in the stock price. Once a trader has identified a stock that they think is a good candidate for short selling, they borrow the stock from another investor who owns those shares. They do this via their broker, who acts as an intermediary between the borrower and lender. The trader then sells those borrowed shares and waits for the share price to decline before buying shares back at a lower price. Traders are charged interest on the stocks borrowed in a short sale. Once the short sale is complete, the trader returns the borrowed shares to the broker, who collects fees and any interest. The trader gets to keep any profits from the transaction. The broker will mandate that you have a certain amount of funds available in your account as collateral before you can make a short trade. If the stock price rises, causing losses in your account, your broker may ask you to top up the collateral. When longer-term investors own a stock, they may receive dividends, which in the long run generally make up around half of their total returns from investing. If you have borrowed a stock to short it, and it pays a dividend, you must pay this amount to your broker. So why is short selling considered to be so risky? Short selling can be very profitable, but it can also be very risky. When you buy a stock, the most you can lose is 100% of the money you invested in the stock. This will occur if the stock you invested in falls to a price of zero. However, you theoretically have unlimited upside. On the other hand, when you short sell a stock, there is no limit to the amount of money you can lose if the stock price goes up instead of down. You can lose more than your initial investment if the stock price keeps going up and you are forced to buy it back at a higher price. You theoretically have unlimited downside. In a short sell trade, your upside is capped at 100%. This is because you would make 100% if the stock price were to go to zero. As you can see, buying long and selling short have an inverse relationship, and both have an asymmetric risk and return profile. When buying long, you have limited downside and unlimited upside. When selling short, you have limited upside and unlimited downside. If short selling involves borrowing stock, if the lender does not want to continue to lend the stock at the end of the agreed period, as the borrower you will be forced to buy it back at the current market price, regardless of the loss. There are other costs as well associated with shorting stock. When you borrow stock, someone will have lent it to you, and of course, no one is going to do this for free. As such, the borrower of the stock is required to pay interest for this loan. Stocks that are considered general collateral can be borrowed at the benchmark interest rate plus a margin of between 0.25% and 3%. Hard-to-borrow stocks such as highly illiquid stocks, those with very tiny public floats, or significant short interest already, can cost substantially more. On the other hand, you can make money by lending stocks to short sellers. To lend your stocks to short sellers, you'll need to open a margin account with your brokerage firm. This account allows you to borrow money against your securities and earn interest on the amount you lend. Short sellers are the borrowers who will pay you to borrow your stocks. Your brokerage firm may have a list of short sellers who are looking to borrow securities, or you can search for borrowers on your own. Once you've agreed to the terms of the loan, you'll need to transfer your securities to the borrower. Your brokerage firm can handle the transfer for you. You'll earn interest on the amount you lend, which is usually calculated based on the current market rate. Your payment will be credited to your margin account. By lending your stocks to short sellers, you can earn extra income on your investments. However, it's important to understand the risks involved, as short selling can be a speculative and risky investment strategy. Before lending your stocks, make sure to do your research and work with a reputable borrower to minimize your risk. It is interesting to note that index funds and ETFs generally engage in lending stock, and this allows them to generate additional income and keep fees very low. Thank you for watching our video on short selling for beginners. We hope you found this information helpful and informative. Short selling can be a complex and risky investment strategy, but it can also provide opportunities for profit if done correctly. If you're considering short selling, it's important to do your research, work with a reputable broker, and understand the risks involved. Always remember to have a solid investment plan in place and be prepared for the possibility of losing money. We encourage you to subscribe to our channel for more informative videos on investing and personal finance. Don't forget to like and share this video if you found it helpful, and leave a comment if you have any questions or suggestions for future videos. Thanks again for watching, and we'll see you in the next one.